Good morning, everyone, and welcome to our webinar on Unravelling the Debt Puzzle. So I think this has been an interesting week. I think it's been a much awaited week for over the past year. We've been waiting for this clarity in terms of what's going to happen on a domestic debt restructure. And now we have a little bit more clarity in terms of what the proposal entails and what the details of it are, and particularly in terms of the holders that will be impacted by this debt restructure. So today we will be going through the details of this and sharing perspectives on other markets that we've seen that have been through this kind of debt restructure as well. So to start off with, before we start off, we would encourage you, if you have any questions, please direct them within the chat and we will take up as much as possible after this presentation is done. So the presentation will take between 30 to 40 minutes and then we will move on to a Q&A session going forward. So in terms of the key debt restructuring targets that have been laid out by the IMF, there are three main ones. So the first one is that public debt to GDP of Sri Lanka should decline below 95% by 2032. So they've given us a bit about a 9 to 10 year period in which we have to achieve this. The second target is on the external side, which is that annual FX debt servicing of the central government should remain below 4.5% of GDP in each year between 2027 and 2032. The third one is, of course, in terms of the gross financing needs. And we'll talk about it a little bit more in detail, and we'll go through each of these targets in terms of our expectations of it, how do we achieve this, and what does that mean in terms of what's next as well. So talking through target one. So target one is that we reach debt to GDP of 95% by 2032. So here what we have is our estimates, and these are CAL's estimates in terms of what we think is going to happen in terms of the debt to GDP estimates. So based on this, we have used predominantly IMF estimates in terms of GDP, but in terms of exchange rate, we have used our forecast, as the IMF forecast tend to have been a little bit more bearish given that it was done at the start of this year, and we've seen quite a bit of appreciation from that point. So what you see here is that with a 30% or a 20% haircut on purely ISBs, that we can reach this target by about 2029. So that gives us ample space in terms of meeting this target. And based on the document that was shared, we can see that it indicates that there is likely to be more of a 30% haircut on ISBs with somewhere around a 5 to 6 year maturity extension. So even in our 30% scenario, you can see that we reach below 95% by 2029, although we hit the 95% mark by 2028. So there is ample space within this target that we are comfortable in terms of reaching it. So this first target we see as quite an achievable one. And actually, in terms of the IMF stance, it has been quite a lenient one compared to some of the other targets that have been laid out by other countries in this kind of instances. So what you see actually is that in the first quarter of 2023, Sri Lanka's debt to GDP, based on the new numbers that have been published, actually stand at about 114%. So you see it has come down from 2022 at 128% to 114% already, without any impact of a debt restructure. And then when you move on and factor in inflation as well as the LKR appreciation impact actually that we have seen in the last couple of months, here we have factored in a year-end exchange rate of 340. You see that our debt to GDP levels actually continue to come down. So from 128%, it comes down to 116% by the end of the year. So a large part of this reduction is actually attributed to the fact that we have had very high inflation over the last 12 months or so. So last year, there has been a 60% reduction in our debt to GDP ratio as a result of the high inflation which we had. And this year, there's about another 20% or so reduction that we will see in debt to GDP because of the high inflation that we've had as well. So even without any kind of a restructure, both on the external or the domestic side, what we see is that debt to GDP comes down from 128 to 116%. And thereafter, taking into account about a 20 to 30% haircut on ISBs alone, you can see that there's going to be a reduction of about 3 to 5% of debt to GDP. So this allows us going forward to achieve this 95% target quite comfortably. So this is on the external side. In terms of target 2, which is in terms of FX debt servicing of the government to remain below 4.5% of GDP, here, this target is also once again very achievable. So this is the pre-restructuring scenario that we have in blue. and the post-restructuring scenario that we have in red. So you see that we are able to achieve below 4.5% based on IMF estimates as well. And this is in terms of a combination of both an ISB haircut, the maturity extension, as well as a coupon reduction on that. And also in terms of the changes that will be there for official creditors or bilateral creditors, which are currently in negotiation, which is most likely to be no principal haircut, but purely a maturity extension and a difference in coupon. So these two alone will help us to reach the targets set out on the FX debt servicing side. So the third target is the one where the question of domestic debt restructuring comes in. And this is because the gross financing needs of the government is a larger challenge. So the gross financing needs is essentially how much a country needs to kind of run operationally within the year. So this takes into account your fiscal deficit, which includes all your interest payments, along with the debt maturities that are due in the year. So if I were to speak it in terms of layman's terms, if you think of a household, you think of the income in which they receive and all the expenses they need to meet, along with any loan repayments and interest payments due. That gap is what you need to essentially bridge. And that is what has been a concern in the last 2 years. So if you look at the GFN for the last year, it came just about 30%. For 2023, the IMF estimates this to be above 40% of GDP. Whereas the target that they've laid out for us is that you need to reach 13% on average between the period 2027 to 2032. So again, this is not an immediate target, but they've given us a few years in terms of reaching that target. But what you see, particularly if you look at the graph on the right, is that in a pre-restructuring scenario, so this is assuming there is absolutely no restructure on external or domestic side, and going along with our current trajectory, that the average of the gross financing needs as a percentage of GDP during this 6-year period will be 16.7%. Whereas if you do a restructure on the external debt alone, which is the blue bar you see here, you reach 14.2%. So you're still having a gap in terms of reaching the 13% target, which is where the question of domestic debt comes in. And once you do restructure the domestic debt according to the proposal that has been laid out by the central bank, you can easily be below 13%. And here they have factored in an average of 12.7% being achievable based on the targets, based on the proposal that they have laid out. So what you see with your graph on the left also is in terms of what constitutes of the largest burden on this gross financing needs. What you see in the pink bar over there is that Treasury bills account for the largest stress within the gross financing needs because they are more short-term instruments and need to be rolled over much more frequently. So this adds a little bit more pressure. But where in terms of the alleviation comes in is that a large portion of this is held by the central bank. And I will get to that in a little bit. But in terms of bridging that gap between not doing a restructure and doing a full-on external as well as domestic debt restructure, there's essentially about a 4.1% gap between that 16.7 as well as 16.8 rather, and the 12.7% that has been noted. So this reduction essentially comes from restructuring central bank holdings of Treasury bills, which will account for 1% of it. The EPF, or the rather superannuation funds, T-bonds, which they have mentioned is going to be 0.5%. SLDBs, which are a small component right now, accounting for 0.1%. And relief on the external side, which is accounting for a larger chunk of it, which reduces that gap by 2.6%. So essentially allowing you to meet the 4.1% gap between the pre-restructuring GFN scenario and a post-restructuring GFN scenario. So GFN, again, once again, is the gross financing needs, or what you call as the fiscal deficit plus any debt maturities that are coming about within the financial year. So in terms of the composition and how they've laid out the debt restructure overall, is that starting with Treasury bills. So in terms of Treasury bills, right now there's an outstanding of about 5.4 trillion, of which the central bank holds a large portion. So the numbers that they have used here are end of 2022, in which the central bank actually held 63% of Sri Lanka's outstanding Treasury bills. So there's been a question with regard to whether the central bank holdings are also with the market. So there's a difference. So central bank essentially acts as an intermediary in issuing government Treasury bills and bonds. So they are also holding these bonds. These are not market holdings, but holdings within the central bank itself. So when they restructure their holdings, there is no impact in terms of the market holdings of treasury bills. And this is a question that we've seen being asked quite a bit since the restructure announcement was laid out. So what you see is that since a large portion of these treasury bills will be restructured, this significantly reduces the burden on the treasury bill front, which is a more short-term instrument, as I mentioned earlier, which is adding the larger burden in terms of our gross financing needs, and why it became a problem over the last 2 years, because there was a larger issuance of treasury bills. On treasury bonds, the primary objective that they have, once again, is in order to ease the maturity bunch up that we are facing in the next couple of years. So you can see that there is a bunch up in the next 4 to 5 years that we will need to kind of keep servicing if we are on the current trajectory. But this is quite difficult in our current circumstances. So what they would want to do is spread it out a little bit more. But within this is where they kind of talk about the voluntary or select pool of T-bond holders in which they will want to kind of propose this restructure to. So there is a gap, right? So there's a 1.5% gap that needs to be met through domestic sources. 1% of it is met through the treasury bill restructuring. So the remaining 0.5% will be met through the restructure of treasury bonds and Sri Lanka development bonds. So the query that has been there overall in the last 3 months since the IMF board level agreement came out is who is the select pool of treasury bond holders going to be. So here we have a breakdown in terms of the holders of treasury bonds. So this is as of end of 2022. And what you can see on the left side is that 43% of outstanding treasury bonds are held by the superannuation funds. Of this, the EPF alone constitutes of about 84% of that 43%. On the other side, the larger holder is, of course, the deposit-taking institutions. And within this, the breakdown has also been provided by the central bank, where 72% is held by the state banks and 28% is held by private institutions and private banks. So this is where the rest of the difference is really made up. So the 0.5% right now is that they're targeting the 43% portion to bridge the 0.5% gap. And based on the numbers available, this comes to the overall holdings of the EPF alone comes to just over 3 trillion. So this gap is more than reachable through just restructuring the superannuation funds holdings alone. In terms of banks, bank holdings of treasury bonds have not been included in the restructure proposal. And this has been something that was laid out quite clearly in that document. And they have cited a few reasons in terms of why banks have been left out of this. So one is that they are facing very high taxation and they have continued to pay these very high tax levels last couple of years, very high NPLs, which have been increasing in the last couple of quarters, as well as they're already taking a hit in terms of the ISB restructuring or the sovereign bond restructuring, of which banks have already provided for about 35% on that. And as a result, they are also holding, in terms of their overall asset base or the overall government security holdings, they're holding about 55% in treasury bonds alone. So if you look at the 3 graphs laid out here, you can see the graph on the left kind of shows you that the stage 3 loans, or what is considered as very high risk loans, the highest risk loan category, has been increasing over the last couple of quarters. And this has been as a result of the economic crisis, which happened last year, as well as the high taxation that has impacted a lot of individuals, as well as companies, as well as the high interest rates that have made it difficult for people to pay back their loans. And as a result, the stage 3 loans component has increased to 13% by May. And then, of course, you see the taxation that they're paying. Banks essentially pay close to half of their profit before tax in terms of taxation to the government. And in terms of their holdings of the government securities, 55% of that is within treasury bonds. So if you do touch that portion, they have noted that there would be an impact in terms of financial system stability. And these are the main reasons that have been cited by the central bank as to why the banks have essentially been have not been included within this treasury bond restructuring proposal. So those are 2 instruments. So one was in terms of treasury bills, one was in terms of treasury bonds. There's, of course, the question on external or the international sovereign bonds, which they have not given as much detail on, since this is more of a domestic debt restructuring proposal. But another one that comes in here is also the SLDBs as well as the FCBUs, or the foreign currency banking unit holdings. So SLDBs essentially are dollar denominated bonds that have been issued under local law. As a result, they come as part of Sri Lanka's domestic debt. So in terms of the holders of these bonds, 85% of the outstanding SLDBs at present are held by banks. This is based on the outstanding information as at May. So you can see that they're already kind of exposed even on this front, although their holdings are of course lower compared to some of their other security holdings. So within this, they have given them 3 options in terms of how they can restructure. So option number 1 has been that they take an exchange that is kind of similar to what ISB holders would take. So all these options are only for SLDBs, which are the Sri Lanka development bonds and the foreign currency banking unit bonds. So here, these 3 options have been laid out for exchange of these instruments alone. So first option is that it is kind of similar to the treatment that they will be giving sovereign bond holders. Of course, this has not been fully agreed upon, but this is similar to what they are putting in on the table for sovereign bond holders. This is essentially a principal haircut of 30%, maturity extension of about 6 years, and interest rate of 4%. Then in terms of option number 2 is where not like ISB holders, but rather like the official creditors or like the bilateral holders. So here there is no nominal haircut. There is a 15-year maturity extension, and it will be a bullet payment at the end. The third option is to get these bonds in LKR terms. So this is given in LKR terms at a more variable interest rate that they will be taking on in this. And so these are the 3 options that have been laid out. And on the right-hand side, you can see the different exposures by the various banks in terms of what they hold in Sri Lanka development bonds as of end of 2022. So BOC holds the largest portion of it. It accounts for about 4.4% of their total assets. And similarly, the other banks you can see are holding the rest of it as well. So this is just in terms of the composition of who's holding the sovereign bonds. So in terms of the structure of the exchange, so if you look at the composition between T-bills and T-bonds, so first going into T-bills, they have laid out a structure in terms of how the Treasury bills will be extended in terms of their maturity, in terms of a breakdown of how it would be spread out as well. So what you will see is immediately, as I mentioned, the outstanding Treasury bill stock is 5.4 trillion. And this is as at right now, of which the central bank holds, again, as I mentioned, a substantial portion of it. If this is completely wiped out, what will be left is only 2.9 trillion, which are only what the market holds. So this you can see when you kind of compute it over a long period of time, particularly if you add on kind of the interest rate of about 10%, rolling over continuously, and then 7.5% from about 2027 onwards in line with IMF expectations. This means that if there was no restructure, overall T-bill stock would at least increase to about 9.9 trillion. Whereas once you exclude that component, the market holdings at those interest rates will mean that as of 2032, which is about 10 years from now, the overall market holdings or overall outstanding Treasury bills will probably be around 5 trillion. So there is an immediate reduction in terms of the Treasury bills outstanding when this restructure will take place. In terms of Treasury bonds, what you see is that, as I mentioned previously, there is a bunch up in the next 4 years. We have 4.3 trillion bonds maturing in the next 4 years after 2026, and 3.9 trillion in the 6 years after that, which is the 2027 to 2032 period, which is the crucial period that the IMF has kind of targeted. And once you kind of take out the EPF holdings, and this is because they provide that breakdown and allocate it and spread it out within that period, they have said it as equal installments in 12 instruments. You can see that it's a little bit more spread out. And here as well, we've restructured in terms of the overall central bank Treasury bills and converting them into Treasury bonds as well. So you can see it has been a little bit more spread out. The pressure, particularly in the near term, reduces by about 1 trillion in the next 4 years. And thereafter, it is a little bit more spread out and going on for a longer period of time. So this is essentially what they would want to achieve with the Treasury bond portfolio. So in terms of certain incentives, particularly since the pension funds or the superannuation funds rather are taking a larger portion of the hit on the bond side, there have been certain incentives that have been proposed by the central bank within this. So one of it, the main one, is that they are proposing that income taxation of non-participating pension funds would be increased to 30% versus their current tax rate, which is subsidized at 14%. So essentially what this does in terms of their return is that they've looked at the period between 2023 to 2038. So quite a long period of time within 15 years, the average portfolio return at current trend would be about 9.4%. Whereas if they do participate in the domestic debt optimization program, this reduces it slightly to 9.1%. Whereas if they do not participate in the domestic debt optimization and instead have to face a higher income tax rate, this actually reduces the returns much more substantially. And this comes down on an average basis to 7.7%. So this is essentially in order to encourage them to take the deal in terms of a restructure. And you can see here actually in the first couple of years in the green line, you can see that the return is actually higher in the initial years, even compared to status quo. And this is because they are offering a higher interest rate of 12.5% for the first 2 years if they do take the restructuring proposal, and thereafter it will be reduced to 9%. So this is to incentivize them to take part in this debt restructure. So another question, of course, that has come up is in terms of the returns for members. So what you see is that this is not likely to have any major impact in terms of returns to members. So what you can see here in the graph is the gross return on the average portfolio over the last several years by the EPF and the interest rate that they have paid for member returns. So the return on the portfolio is given in blue and the member returns are given in the pink bar. So you can see that there has always been a discrepancy between the two. And particularly in the last 4 to 5 years, the returns for members have been hovering around 9%, whereas the return on the portfolio has been a little bit higher than that. And based on our calculations of 2022, despite very high interest rates, the average return on the portfolio was just above 9% based on the numbers that they have published. So you can see that there is not really going to be any impact. It is likely that members will still continue to get around the 9% returns, which they have been getting in the past 4 years, despite this kind of a restructure. So that is in terms of the overall debt targets. So all of it looks quite good in terms of the first two proposals, as we mentioned, with the restructuring on the external side, we are able to hit target number 1 on the debt to GDP and target number 2 in terms of the FX debt servicing, whereas target number 3 on the gross financing needs needed a gap to be bridged, which would be bridged through the domestic debt restructuring side. But of course, this is not the only thing that the government, of course, needs to do, right? We have further steps that we need to meet as well. One of it is that we need to ensure that we're sticking to our fiscal targets and that there is fiscal discipline that is continued to be looked at over the next couple of years. So the IMF has laid out certain targets, particularly on the primary balance side, but in terms of the fiscal side, these are the projections that they've given us. So you can see that there is a steep reduction in the fiscal deficit, particularly compared to kind of the double-digit fiscal deficits that we have been running over the past 3 to 4 years. So there is a little bit more that needs to be done in terms of the fiscal side in order to ensure that some of our debt targets are not breached because we didn't really control the fiscal side of things. So for example, here we have the primary balance target given, and you can see that the target that they've laid out is that you reach 2.3% by 2025. So for 2023, I think it looks like we are quite on track. The government reported that they had a primary surplus in the first quarter, and this was despite revenue not actually meeting their targets. This was mostly because on the expenditure side, there had been a much more of a cut down or more of a rationalization. It is yet to be seen how much of that will kind of continue within the year. But this target, based on the interest, based on the tax rates and the initiatives taken on that side, does look quite achievable. But there's a little bit more to be done if we are going to reach a primary surplus. So primary balance essentially is your the government's overall revenue minus its expenditures, but excluding its interest payment. So this is kind of looking like an operating profit or operating balance of the government. right? So Sri Lanka has only achieved a primary surplus twice in its overall history. So achieving a primary surplus in a short period of time is a little bit of a steeper ask by the IMF. So they've also proposed, in line with achieving this 2.3%, a couple of further tax increases. So part of it will be met not just by the increased taxation, but also by widening the tax net and through more efficient tax administration measures, which is something that the Ministry of Finance has been kind of focusing on over the last couple of months. So this will increase the tax net and bring in more people into the fold in terms of being able to actually reach some of these revenue targets. But the IMF has also proposed some sort of a property tax that will be imposed from 2025 onwards. The terms of this are, of course, not specified as yet, but this is expected to kind of increase that tax revenue proportion and help them reach that primary balance target. On the expenditure side, I think there's going to be a lot more control in terms of public investments and in terms of recurrent expenditure as well. But another significant one is in terms of managing its interest cost. So Sri Lanka, while the proposal has been now put forward and we do look closer in terms of achieving it, but we need to make sure is that interest costs don't go and blow out of proportion, which is one of the problems that we had in the last 2 years, right? So we need to make sure that this restructuring is completed within this year, that interest rates do not shoot back up and make it more difficult in terms of financing it. Because if there is no finance, if this does not close within this year, then future foreign funding also becomes more of a question mark. Of course, there has been quite a bit that has been released already from the ADB as well as the World Bank in terms of budgetary support that will really help in terms of meeting some of our financing needs for this year, but we need some of that to continue going forward as well. So if, for example, we just done a simulation here, if, for example, there was no foreign funding that was received and interest rates were raised and new financing was raised at 25%, this would on average add about 500 billion in terms of the overall expenditure for the government. So this is something that we need to make sure kind of doesn't go out of handle once more, to make sure that we are able to reach our fiscal targets and thereby help us achieve those debt to GDP targets as well. Moving on, just to kind of, now that we have this news, we're looking at a couple of market reactions in other countries, both in terms of fixed income side as well as on the equity side, in terms of what happens after a restructure of this sort. So we've taken a couple of examples and some of it. So Ghana being the most recent one. So this is in terms of the interest rate here. What you can see is that Ghana, for example, the graph on the left, you can see is that as soon as the debt exchange was completed, and this was the first phase which was done in early March, you can see there was a steep reduction in terms of the Treasury bill rates, and by 10 percentage points, it happened almost immediately. So what's interesting here also is that in terms of Ghana's own debt restructuring proposal, Treasury bills were always left out of the perimeter for domestic debt restructure. However, it was only after the exchange program was actually completed and where the bonds were exchanged in which Treasury bill rates also came off. So this is something that maybe we could expect for Sri Lanka as well, with this clarity coming in that interest rates would take a sharp turn downwards. Similarly, again in Jamaica as well, they also saw a reduction in the lead up towards the debt exchange. And once it was completed, they had about a 12 percentage points drop in terms of their T-bill rates as well. So what you see is that there is likely to be an adjustment in terms of interest rates downwards with the clarity provided from this domestic debt exchange. And in terms of equity market reactions, and here we've taken two, again, more recent episodes. Here we have Ghana on the left, provided these are much smaller markets compared to Sri Lanka. The reaction has largely been positive in recent episodes. So you can see Ghana's reaction, equity markets moved up quite substantially soon after the conclusion of the domestic debt exchange. And in Zambia, they did not have a domestic debt exchange, but it was an external, it was a discussion more on their external debt. Their equity markets actually picked up just after the first review of the IMF facility. They just recently, over the last week, obtained or completed their negotiations in terms of external debt, and the reaction of that is yet to be seen. But you can see equity markets take this kind of certainty a lot more positively. In terms of future timelines, What we see is that in terms of the domestic debt optimization plan, there is a slight delay that we've seen so far since the IMF board approval. But for this week, the plan is essentially that yesterday and today, there will be discussions held with government officials as well as the Committee of Public Finance, and they will gather the feedback from other creditors as well that are holding domestic bonds. And thereafter, the COPE will provide their approval by the end of day today. And tomorrow and day after, which is Saturday and Sunday, you will see this proposal being tabled for a debate as well as a vote in Parliament. So essentially, they're trying to kind of expedite this process and ensure that there's limited impact on the financial system, and try to kind of get this process over the hedge as fast as possible. In terms of the overall IMF timeline, though, so this is just one part of it, which is the domestic debt part of it, and we've seen a bit of a delay in that already. There is still further negotiations that need to take place in terms of finalizing the external debt front. There has been a lot of progress that has been made. So we could possibly see these targets being achieved. For example, the end of the negotiation coming in July is something that is quite possible, and thereafter it being implemented. So the hope and the plan is that they would be able to kind of complete both of these by September 2023, which is also the same time in which we fall for our first program review by the IMF. So once this domestic debt restructure is completed, we will also have to continue with our external debt negotiations before going forward into the next stage in terms of the IMF program. So I just wanted to keep it relatively short in terms of going through what has happened so far and some of the next steps to come as well in terms of market reactions, and also in terms of the timeline for the debt restructuring that will take place going forward. I'd be very happy to take any questions that come up in the presentation or any other questions you have with regard to this right now. So taking up a few questions that have come up within the chat. The first question is with regard to local individuals holding treasury bonds and what will happen to that. So I think local individual bonds, individual holdings of bonds actually constitute to, I would think, based on the last numbers released, for about less than 3% of the overall bond holding. So far, within the perimeter of this restructuring or the voluntary pool that has been put forward, individual bond holdings have been excluded based on the information that has been provided thus far. So there will not be any impact in terms of individuals holding local treasury bonds. Yeah, so there are a few other questions in terms of treasury bills as well as bonds that have been bought through CAL and whether they are going to be affected by this. Again, I think it answers the same question as I answered previously with regard to individual holdings of bonds. Again, this will not be affected by the domestic debt restructure that in terms of the proposal that has been put forward. The only bondholders that will be affected is in terms of the superannuation or the pension funds. There's another question with regard to whether there will be further reviews after the restructure and whether we can expect further restructurings. So yes, in terms of the IMF program, they will have reviews every 4 to 6 months or so, and this is very regular process under an IMF program. So they will continue to monitor not just the restructuring targets, but also in terms of inflation, whether we're hitting the targets on that, whether we're hitting the targets on the primary balances and the fiscal targets that they have laid out, in addition to certain other reform measures that they have proposed as well. So there will be check-ins every 4 to 6 months, and based on these program reviews is when the next few tranches will be continued to be released. Whether we can expect further restructurings, it's really dependent on the success of this one. As at the moment, in terms of the numbers that have been put forward, it does seem like it is quite enough in terms of achieving the gross financing needs targets. But as I mentioned, they need to also ensure that they are sticking to their fiscal targets, not letting expenditures be higher than the revenue, in which case it increases the fiscal deficit, which means there's more burden in terms of financing that deficit, and then how do you find that mix is also a question. So there are certain other things that we need to meet in terms of the fiscal side in particular to make sure that we don't have to kind of go through this process again within a short period of time. There's also a question in terms of how interest rates will be affected after domestic debt restructuring. So as I covered in the presentation already, the reaction that we've seen, particularly in other markets, is that interest rates tend to fall off quite sharply. So as you have seen over the last year or so, there has been quite a bit of a risk premium that has been added on to both Treasury bills and Treasury bonds, which is why we saw interest rates trading well above 25%, even into the 30% ranges, because of this risk that had been factored in. So what you see is once this risk has come off, particularly if you look at, for example, Treasury bills, which is an easier one to explain, because there is no risk of market, or for the last couple of months alone, there has been no risk in terms of market holdings of that being restructured. It means that the risk premium on that would need to be reduced or come off completely, and thereby you see a reduction in interest rates as well. So now that there's more clarity on the bond front, what you would also again expect to see is something similar, where since there is no impact on other holdings or the old bonds of the market participants, individuals included, as well as banks, what you will see is that once the risk premium comes off, that the interest rates should ideally reduce in this kind of scenario. I think even some of the movement that we've seen over the last couple of weeks in Treasury bills, particularly in addition to the policy rate cut, is that there is a reduction in terms of that risk being factored in. So there's a question with regard to the superannuation funds. They have mentioned about participation and non-participation scenarios. How does this work? And is it mandatory to participate in the DDR or not? So for superannuation funds, they are essentially enticing those funds rather to participate in this domestic debt restructure. So it is similar, for example, in terms of Ghana, where they had banks within the proposal of a debt restructuring, where they had certain measures like all bonds, if they are not restructured, will be risk rated at 100%. This is kind of a similar thing, but implemented for the superannuation funds in this instance. They're mentioning that income tax rates, which are currently at a more favorable rate of 14%, will instead be increased to 30% if they do not participate. So they have not made it mandatory. It is a voluntary option, but there will be an incentive in terms of participating, because they will be able to be kept at the 14% interest rate rather than being increased to a 30% income tax rate if they do not participate. So in terms of the SLDBs that have been included in the restructuring and the impact on banks and their provisions. So on the SLDB front, a lot of the banks have already impaired for about 10% of this. There will be a little bit of an impact in terms of future provisioning, and we're yet to see, depending on the deal that they take as well. But if they do take it in LKR terms, there's not likely to be too much more provisioning that is necessary. Plus, we're looking at in terms of their total assets, in terms of private banks, a lot of them holding less than 2% of their assets in terms of SLDBs. So in terms of provisions, there's not likely to be substantially more if there is a little bit more provisioning that will be needed on the SLDB front. There are a few questions with regard to our interest rate as well as our exchange rate expectations for the end of the year. We hope to cover that in another session that we'll conduct in the weekend, along with our equity views as well, where we will provide a little bit more clarity in terms of our thinking on this. I think broadly, if I were to very broadly mention, we do expect interest rates to come off quite substantially within the second half of this year, now that this risk has come off. And we also do expect to see further policy rate cuts to the tune of 300 to 500 basis points being implemented over the second half of this year. With regard to the monetary policy statement next week, which there is another question on, I think there is definitely space for the central bank in terms of cutting rates, and it is a possibility that they might look at, particularly in terms of since inflation particularly has come down at a faster pace than both the IMF expectations as well as the central bank fan chart forecast which they had given. So they do have space to cut down interest rate policy rates further in the next meeting, and this is something that is looking a lot more likely. But we do expect overall in the second half there to be further interest rate cuts, policy rate cuts between the tune of 300 to 500 basis points overall. On the exchange rate, very briefly, if I'm to mention, we do expect that there will not be further appreciation from this point going forward in terms of the exchange rate. We think that once this is finalized, there are certain payments that will start falling due. So, for example, we will need to start paying off the Bangladesh swap that was given. certain ACU liabilities that will come due, as well as we will have to start making interest payments once the exchange of the external debt or the ISBs are completed. We'll have to start making a few payments on that. But overall, I think if you look at the current account side, things do look a lot more positive. Remittances are staying high. Tourism inflows are going to be quite high. But it's really the fact that we have suspended our debt repayments that has helped our exchange rate so far. So once we have to start making these payments, we do expect that there will be a little bit more depreciation pressure coming towards the end of the year. We don't expect it to be very substantial. Our exchange rate forecast, if I was to give you very briefly right now, is somewhere between 320 to 340 and going with a wide range right now. We will give a few more specifics in our presentation later on. There's also a question on potential impacts for banks and interest rates on personal loans, mortgages, as well as deposits, both in local currency and foreign currency terms. So essentially what you will see right now is that with interest rates reducing, there will be a reduction both in deposit rates as well as lending rates. So this does really have nothing to do with the debt restructure in itself, but rather just a factor of interest rate pressures coming off. With inflation subsiding, economic growth needing to be stimulated, and in line with policy rate cuts that have been and will be implemented by the central bank. So, for example, right after the policy rate adjustment over the last month, banks reduced the deposit rates from about 15 to 17% to about 10 to 12%, which is where they stand at right now. So if there's a further adjustment or further policy rate cut that is implemented next week, we may see deposit rates reducing further downwards. In terms of lending rates as well, this is a similar trend that we would be expecting to see. Of course, it has been a little bit slower in terms of adjusting compared to deposit rates. But we are seeing the effects of that coming in right now. So AWPLR, which has been well above 20% for a larger part of the last 12 months, we saw it coming down to below 20% over the last week. And we expect this trend to continue. It can accelerate if policy rate cuts are done at a faster pace as well. There's a question in terms of color on the banking and finance sector comps in relation to their profitability, earnings, and capital. Once again, we do think the fact that the banking sector has been kept out of the domestic debt restructure, as at present, based on the present details we have, is positive for banks overall. But we will have further details on this that we will be able to provide to you in a future session. There's a few questions in terms of the impact on unit trust investments. So unit trusts, in terms of as being bond holders, again, are not included within the perimeter of the restructuring proposal that has been put forward. It very much depends in terms of some of the holdings of the unit trust themselves, what bonds they're holding, how bills they're holding, and the reaction in terms of the market reaction on interest rates that will only make the difference within this. So there is no direct impact. It's just the impact of interest rates coming off that will affect them. There's a question on the income tax increases for the funds that do not participate in the restructure, and will it pass on to customers? So within, as I mentioned, within the EPF or the fund superannuation fund returns, if it is passed on because of this, it will really be that the members' returns will reduce if they do not take the option. Whereas if they do take the option, there is very marginal impact in terms of their portfolio returns. And as a result, there should not be an impact in terms of overall member returns. But if they do not take the option and their tax rate then increases to 30%, which reduces their average portfolio return to 7%, in that instance, there could be a reduction in terms of the member return. But if they do take the proposal, which they are likely to, given that there is an advantage here, then there is really not much there's not really going to be an impact. They of course cannot pass it on directly in terms of to any deposit holders within the funds. So there's one question asking whether the recent foreign bond holders that have entered the market would exit when interest rates come down, and whether it will affect the LKR USD rate due to more outflow pressures, because there's been over $500 million that has been invested recently. So yes, Kasun, this is one of the reasons that we do not expect further appreciation in the currency. Foreign holders are also looking at returns. So as long as the return looks attractive, they will enter the market. So since there has been appreciation, there has been a further return that they have felt. And now we see more depreciation risk, although it is not substantial. But since interest rates are coming off, while globally the differential in terms of interest rates, you're seeing rate hikes or continued rate tightening in the global markets, the differential reduces, and as such, we could look less attractive, and particularly because they have invested mostly in treasury bills, which are short-term instruments. If they do not roll over, there could be a possibility that this money does exit the market, and that poses a bit of a risk in terms of the currency, which is something that we have factored in terms of our currency expectation. Yes, there's a question in terms of the SLDB restructuring in terms of option 2 as well as option 3. Yes, this is a mistake in terms of the slides. There is no nominal haircut of 30% that will be undertaken under both of these scenarios. It is only a maturity extension or the option of taking it in rupee terms. Sorry, this is just to clarify, there was a mistake on the slide. There's also a question in terms of the holders, whether companies holding bonds are also classified under individual holdings. So yes, essentially under the individual bondholders, companies will also be included. So in the other category, which has been left out of this proposal, you see certain categories such as insurance companies, in individual bondholders also within the other category, which has been kept out of the debt restructuring proposal. There's also a question in terms of whether we have any clarity on why the central bank T-bill restructure is phrased as part of phase 2 of the domestic debt optimization program, and whether we expect all central bank treasury bills to come due in 2029 or spread over 2029 and beyond. The question here in terms of why it is put in phase 2. Phase 2, I don't think is necessarily that there is going to be another round of negotiations, but rather that in terms of the format of how they will go about this overall restructure or the overall exchange, first, I think they will deal with the treasury bond exchange, and then they will move on to the treasury bill exchange, because they can then work out the capital impacts in terms of the central bank itself. It would not be we don't expect it to be another stage of negotiations, but just that in terms of the timeline of events, first they will handle the treasury bonds, then they will handle the treasury bills. And in terms of how the spread is, they have mentioned in terms of a breakdown of how they're going to spread their treasury bills. It will not all fall due in 2029. They have given an allocation in terms of 4% spread over the next couple of years and about 14% on average thereafter. So it's a little bit more equally split, with a lesser burden coming due in the first couple of years and then the larger portion of the dues coming thereafter. There's also a question with regard to the mechanism of capital rebuilding of the central bank balance sheet, which is impacted by the treasury bill conversion, and what the impacts of such an action are. So what we see here, and we have tried to do extensive research within this as well, is that yes, there will be an impact in terms of the capital of the central bank. They will be able to kind of make it up in part going forward through any profit retention measures that they kind of take on. So for example, in terms of the central bank's accounts alone, you see that certain times there are transfers that are made to the treasury on any excess funds they have. So they might scale back on this and instead put it within the central bank's capital alone in terms of building that capital base. We will try to quantify it in terms of what that capital hit is, but it is not something that is really going to affect the market as a whole. We do see certain other countries where their central banks do run on negative capital as well, and there is not much of an impact in terms of the overall market as a result of a central bank running on negative capital. So it's quite different to the bank in a regular private bank impact versus what happens in terms of a central bank's capital. So it's more of a book kind of loss that they will face. There's also a question with regard to the potential property tax proposal that will come due in 2025, and any further information that we have on this, whether it's an annual tax on the value of the property. That there's not too much detail that has been provided on this already. It is a proposal that has been put forward by the IMF. So it could be either implemented as kind of a transfer tax in terms of if property is transferred, at that point there's an increase in taxation that takes place, or it can be kind of in the form of wealth tax as well. So this is essentially to ensure that those who are making kind of have increased their wealth or have increased their incomes in the past couple of years can kind of get captured within that net as well. It is essentially a measure to broaden the tax net a little bit more, but there are no specific details in terms of what this property tax will entail. Again, there's a question in terms of the impact on the insurance sector. So here as well, they are not they're not included in the perimeter of this restructuring. Again, the only impact they will have is with interest rates, which are expected to reduce coming down, which can reduce their returns in terms of the portfolios that they have locked in. But there is no direct impact from a restructure for insurance companies based on the information that are available right now. There's also a question in terms of, and this I think might be the last question that we have time for today, is whether we can expect any relaxation in regulatory ratios for banks due to the impact from SLDBs as well as ISBs. So there has already been quite a bit of regulatory forbearance that has been provided to banks by the central bank. In terms of ISBs and SLDBs, and because that is now the primary impact that they will be taking on international sovereign bonds, as we mentioned, most banks have provided up to 35%. Some have provided in excess of that. On SLDBs, they have provided up to 10%. There might be a little bit more on both of that will need to be provided for. But by and large, since this is something that banks had been prepared for over the past year, we might not see too much regulatory forbearance being necessary in this instance. But we've already seen, for example, 2.5% in terms of capital buffers that have been provided to the banking sector, which no one has really gone in terms of using. So they have that buffer in terms of regulatory forbearance as well. So if there is any further kind of impact that is unforeseen, there could be regulatory forbearance. But as it stands at present, they look quite comfortable in terms of the regulatory forbearance that has already been provided. And with that, I think we can conclude our session today. Thank you very much for joining this session. We hope it was an informative series that you were able to kind of get a better understanding of the domestic debt restructure. We understand it is quite technical in itself. So therefore, understanding it in layman's terms is quite important, and understand the implications of it as well. So we hope to see you again. We hope to have another session in terms of our views and our outlook, both in terms of the macro side as well as the equity side and certain sectors that we want to touch on as well. We hope to see you in that next session in the next couple of days. Thank you very much.